I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, 500,000 in the next cycle, I think is really high. But that's 4+ years away.
Every crypto cycle feels different while you're in it, but the emotions never change. There's excitement when price runs ahead, confusion when momentum slows, and hesitation when long-term holders start questioning their conviction. That's exactly where investors are right now. Instead of reacting to price alone, this video turns to someone who's spent over a decade studying Bitcoin cycles. Mark Yusko, founder of Morgan Creek Digital, and one of the earliest institutional voices in the space. In a recent interview, Yusko argues we are entering a crypto winter, but a much milder, more structural one than past crashes. He points to Bitcoin's fair value, adoption curve, leverage trends, and long-term holder behavior as evidence that this is a controlled reset, not a collapse. In this video, we break down Yusko's key insights, the real mechanics behind Bitcoin's market, why the 4-year cycle still matters despite ETFs and institutional flows, and why this moment may actually be setting up one of the strongest long-term opportunities of the next cycle.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
The nice thing about Bitcoin is it's a network, right? It's physically, literally and physically a network. It's a network of nodes that secure a blockchain that enables Bitcoin to be a better form of money going forward. And therefore we can measure all the elements of a network just like any network. And I have a buddy in the industry, Tim Peterson, who runs a firm called N Squared Crypto, and he's N Squared Value on Twitter. And he's been tracking this model, this Metcalfe's Law model for years. And based on that calculation, he comes up with a fair value of the Bitcoin network, the Bitcoin blockchain network, at around $91,000 or $92,000 today. And what's interesting is if you look at history, in 2017, that value was $10,000. Now, if you remember, we went from $10,000 in November to $20,000 in December, so we got 2 times fair value. And then we had a big correction and we fell well below fair value until the next bull market started. Then in 2021, fair value had gone up to about 33K, but we went all the way up to 69K in November of 21. And then we had a big correction. So here we are in 2025, same 4-year cycle, fair value at 91. We only got up to 125. 126, we didn't get a full 100% higher. We never hit that 170, 180 that people were calling for. And so I will argue that the correction will be more muted because of that. Because, it's likely we fall not just back to fair value, but probably below. Well, why should we fall below? Well, corrections occur when people who bought for, we'll say, less than ideal reasons. Like if you think about the cycle of any investment, when the price is below the fair value, right? And if that's a stock, it's the discounted stream of future cash flows. If that were a bond, it would be the certainty you have with the payment of interest. Whatever it is, if the price is equal to fair value, you're probably agnostic as to whether to buy it or not. If the price is below fair value, investors will buy to try to close that gap. Well, as the price starts to move, traders are drawn to it because traders don't really care about fair value. They just want movement. They want to go long or they want to go short, and they trade. Well, as the price starts to get above fair value, hedgers emerge. Well, what's a hedger? A hedger is someone who owns a commodity whether it be oil or gold or Bitcoin. Bitcoin's classified as a commodity, that produce it. And they now say, well, wait a minute, if the fair value is here and I can sell it at a price above fair value, well, I know I'm going to produce it tomorrow, so I'll just sell it in the futures market. And if you can sell an asset in the futures market, you need someone to take the opposite side. Those are called speculators. So speculators are taking the opposite side of a hedger. Well, then that increases the price. Now, when the price starts to really get higher above fair value, now the gamblers come in. And the gamblers not only buy the asset because it's moving, but they use leverage. And leverage is not evil in and of itself, but it's the amount of leverage relative to the volatility of an asset. So what happens is, as those gamblers push the price to too high a level, it snaps, they get liquidated, the price starts to fall. And as the price starts to head towards fair value, the traders get nervous, so they sell, and the price gets down. The hedgers can't sell because now the price is below fair value, so they'll just hold it until the price goes back up. And then the long-term investors wait until the price gets down here and they start buying again. So you get this natural cycle. I have empathy for the logic of the 4-year cycle being less relevant because we had a step function change in demand. Because at the end of the day, price is determined by buyers and sellers. And if there's, a lack of buyers, then the price needs to come down to meet that demand. If there's a surfeit of buyers, then the price needs to rise to meet the increased demand. So there is some logic to say, well, we have all this new money going into Bitcoin through the ETFs and institutional adoption, but there's one flaw-ish in that logic, which is, remember, every transaction, there's a buyer and a seller. For there to be excess demand, you would have to have, fewer sellers for price to rise. Meaning, the hedgers aren't producing as much. That's what the halving does, right? The halving intentionally deflates the number of block rewards. And so if I'm a hedger and I own a mining rig and now I only get 2 block rewards instead of 4, my costs are the same. I need the price to rise, so I'm less likely to sell until the price rises, which is part of the genius of the halving in my mind. The difference now is that for every new incremental buyer that we've seen, there's OGs, right? Wallets that have been inactive suddenly selling. And we're like, oh, that's so terrible. No, it's not. Look, if we meaning the community, want there to be billions and billions of Bitcoin owners and users, it can't all be in the hands of a small number of whales, right? Just mathematically. No, you say, oh, but it could, and the new people just get smaller and smaller increments. Sure. I mean, we can divide into 100 million Satoshis per Bitcoin. That's fine. But there are people who have very, very low cost basis who at some price will say, you know what? Yeah, I'll distribute a little bit.
Yusko reframes Bitcoin's price as driven by fundamentals, not hype, with a model-derived fair value around $90,000. Limited upside and reduced leverage this cycle mean fewer forced liquidations, making drawdowns more likely to be buying opportunities than crashes. He contrasts this with bullish narratives around ETF flows and institutional buying, noting that supply from dormant wallets and miners can still meet demand. Metrics like ETF inflows, funding rates, futures open interest, and active addresses show how narrative translates into on-chain reality. Finally, Yusko highlights structural differences from traditional commodities, where leverage and futures dynamics have muted volatility. His takeaway: we're in a bear market, fundamentals dominate, and strategic accumulation opportunities are high.
It's highly likely Giovanni, that we don't have the same extremes, either up or down, partly because the amount of leverage that people can use has diminished, right? You can't get 100 to 1 anymore. You can get 50 to 1 in some places, and usually it's more like, 4 or 5 times. So if the leverage is less, you won't have the extremes. The reason gold doesn't have as much volatility is it's harder to lever. It's a more mature market. It's much larger, right? It's 10 times bigger than the market of Bitcoin. I mean, gold lost a whole Bitcoin in 2 days the other day, right? I mean, it lost 2.8 trillion in 2 days after going up 10 trillion a year to date. And so the law of large numbers says that you're not going to have the same level of volatility because you can't get the same amount of leverage. There's just not as many people that The second thing is gold has been a commodity longer than Bitcoin. And what I mean by that is there's a reason Bitcoin was labeled a commodity, not a security. And it's not a good reason, actually. It's intentional. Anything that's a commodity can be manipulated by the largest players in that commodity through the futures market. Well, that's a process known as spoofing, where the big guys, JP Morgan and Goldman and all these other guys in Europe, they are selling futures to compress the price, and they are day trading around it, which is technically illegal, and they pay fines. This is the crazy part. 2 years ago, JP Morgan paid a $940 million fine, almost $1 billion fine, didn't have to admit any wrongdoing. Commodities and futures markets tend to have this rapid movement. That's a short squeeze. Because when the price is being manipulated, you got all these shorts, they're naked, and somebody starts to buy, whoever that is. This time it was China. China started buying gold. Well, now gold went into a super short covering. So all these guys, JP Morgan, they're having to cover their shorts, and we went from 3,400 to 4,400 instantaneously. Okay, well, now what's happening? Now they're back to shorting again. So now they're not shorting at 3,400, they're shorting at 4,400. And we went from 4,400 all the way back down to 4,000. And so it's that constant process of, spoofing, punctuated by these big short covering rallies. And again, this is that distribution. You got the OGs selling into it for the first time, which is good. We want that. We got fewer new buyers. We still have some, but we have fewer new buyers. And we've got the constant downward pressure from the futures market that's kind of capping prices. So, I think we're going to be stuck in a kind of squishy zone for a while. I don't think we're going to have a massive correction like the last 2 cycles because we never got super overvalued. Do I think it could go down into the 70s? Yeah. I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, okay, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, 500,000 in the next cycle, I think is really high. But that's 4+ years away. So what I think people should do, so I was on TV in 2018. And while I was on the show, literally, and I was on the show for like 6 minutes, but while I was on the show, the price went from 10,000 to 8,000. So it was a big move, right? And the host says, well, what should we do? I'm like, we should buy it. She says, well, you would always say that. I'm like, yeah, I would. Buy it today, buy it tomorrow, buy it next week, buy it next month. Don't buy it all at once. Figure out how much of your portfolio you want to own. Buy some today, buy some next week, some next month, the month after, and keep accumulating your savings bucket, right? Don't put the money that you need to pay the bills into a volatile asset. stocks, bonds, anything. I mean, that you need that to be in money that you can spend. But if you want to save your value and protect it from the ravages of inflation, you should be shifting as much of your savings bucket out of fiat into Bitcoin. But you shouldn't do it all at once. So in 2021, when we talked, we were in phase 2 of the 4 phases of innovation. So in the first phase of innovation, the incumbents ignore you. So from kind of 2009 to 2015, they ignored it, right? A bunch of nerds and geeks playing with their magic internet money, whatever. Then phase 2, kind of from 2016 to 21, you have the then they laugh at you phase. And they mock you. And, stupid idiots playing with your magic internet money. But starting in 22, and I'll argue from 22 to kind of 27-ish, is the then they fight you phase. That's where the incumbents fight back, right? They try to erect barriers. They try to change regulatory rules. They try to, you had the whole, Operation Choke Point. I mean, you had all that stuff. And people say, well, that's over. I'm like, it's not over. I mean, Trump was going to give us a strategic Bitcoin reserve, right? Nope, we haven't seen that. Why? Well, because there's still people in D.C., Elizabeth Warren and others, that don't want that to happen.
Yusko's biggest takeaway is simple. Treat Bitcoin like a savings asset and plan around that reality. For long-term investors, this means accumulation rather than trading, dollar cost averaging into a portion of your net worth you can afford to hold over months and years, and using on-chain and flow data to scale buys with confidence. This cycle is less leveraged than previous ones, so while volatility remains, extremes are softer, making drawdowns buying opportunities rather than triggers for panic. We're still in what Yusko calls the then they fight you phase, where regulatory pushback, short-term sell-offs, and messy market mechanics are part of the institutionalization process, ultimately bringing more liquidity, participation, and stability over time. The macro bull case is very much alive. Yusko expects new all-time highs over the next multi-year cycle, potentially surpassing $500,000, though not immediately. Mild pullbacks flush weak hands, improve distribution, and set the stage for the next major move. In short, the strategy is straightforward. Treat Bitcoin as savings, accumulate consistently, avoid high leverage, and view corrections as opportunities to build your position rather than reasons to exit. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.